First, obviously, the coronavirus topic is what's being tied right now, most obviously, to this market sell-off. But we were already getting real frothy in valuations by some metrics, the most since .com. So how do you sort of weigh these two things together?
Now look, obviously you've seen quite a run over the last year or so. What's interesting is you saw that run in the context of slowing earnings, but really the key for me has been seeing that run in the context of lower and lower yields. So of course, everybody's watching the coronavirus. You can't take it lightly. At the same time, you look at the average number of flu deaths every year is between 12 and 60,000 people, and that's just the regular wave flu. So, and once we get through this, I'm going to be looking a lot at the Federal Reserve. Obviously, again, lower and lower rates has led to, in my view, room for higher valuations. So steady earning stream companies, maybe some of the new utilities, those are the things that I think are going to provide some backing for investors.
I want to talk about some of these stocks in just a sec, but another point on the macro here, because what you bring up is so important. We had a low yield environment, lots of multiple appreciation last year, but yet it still seemed, Jason, like the bond market was looking for more Fed action than the Fed has signaled. There's now an 80% chance of a cut this year, according to Fed Funds futures, even though our economic surprise indexes, tracked by Citi, were at the best rate for U.S., China, and Eurozone combined in 2 years. So how does that fit together? Yeah,
right. Look, I mean, you saw the durable goods numbers this morning, but you also saw the home price numbers, which were better, some of the best in 9 months, which is pretty directly attributable or at least affected by rates. So, yeah, I think that people kind of get used to the Fed cutting rates, cut cycle. I would kind of watch what you wish for in that case. Usually when the Fed cuts more than 3 times, what that means is it's not an insurance cut or set of cuts anymore. It's really reacting to economic weakness. Tomorrow when Powell has his testimony, I think it'll be important to look at, what does the Fed view as success? Are they viewing equity prices being higher as success? Are they talking about the global economy and whether or not that's affecting the U.S. economy? These are key elements to whether the Fed is going to continue to cut rates and be even more accommodative in the face of, as you say, good economic or relatively good economic news.
With bonds, when they were at 1.85 pricing in a cut this year, it seemed like maybe we were in the risk of a bond sell-off that could hurt equities if it happens fast enough. But now you've got these fears building. I guess we don't have to worry about that now, Jason? Or if the coronavirus thing stops tomorrow, do we really have to worry about a bond sell-off?
Yeah, look, I think that the elements of fixed income being attractive to investors has really been a total return phenomenon. At Thornburg Investment Management, we're looking forward and trying to say, okay, what does this value give us? Is a significantly negative real yield 10-year treasury really a place that we feel like is good for investors' capital? And the answer is frankly no. So there are other places to put your money because not that we're going to see a giant sell-off, but the reality is, look, where we are in tens, the additional stimulus to the overall economy, but maybe a different way to say it just in the context of the 10-year or treasuries overall, the additional capital appreciation room is much, much lower than when we were in the threes, a year and a half ago. So I think that's what investors need to look at as prospective returns, and certainly that's what we're focused on at Thornburg. Let's
talk some stocks here. One of your holdings this morning, Pfizer, it's been on a real nice recovery over the last 4 months since getting beaten up in the summer. It's going to come under a little pressure again this morning. Any thoughts on the earnings?
Sure. Look, I mean, I think the company more or less, they said they were being appropriately conservative, which in our view is a little bit code for sandbagging earnings post the announcement of the Upjohn merger with Mylan and the sort of RemainCo of Pfizer. We feel like you're basically getting the pipeline of Pfizer for free. 13 odd times PE is a discount to the global market, the U.S. market, and the group. That's a really interesting place for capital.
Now, the pipeline for new drugs, this has been a super competitive market within the big cap pharmas. Everyone wants to have an oncology, giant like a Keytruda or something like that. Is Pfizer not shining in that realm right now next to some of its peers?
Look, I think the pipeline, again, is something that is attractive. I think you're going to end up with a really great biosimilar franchise, but ultimately, it's at 13.7 times and almost 4% dividend yield. That's really not much in the stock. I think that the company's been executing on really excellent strategic initiatives over a number of years. The Zoetis spinoff, the Upjohn spinoff to merger with Mylan. These are shareholder accretive actions, and I think the company deserves some credit for that. So it's both a pipeline element that's pretty good, but actually also a steward of capital, especially in the context of the marker for the dividend, which again at close to 4% is certainly a lot more attractive than mid-ones for the 10-year.
So this is kind of like a value stock combined with a dividend play. Is there political risk in here? I know that right now the market action's been attributed to this virus, but as we mentioned at the top of the show, you've got an election season coming up that might be getting a little bit more extreme on both ends. We've got Bernie Sanders rising in polls. In the past, he's been stock negative for this group.
Yes, look, that is a risk certainly to the group and to the stock. Again, I get a lot of comfort from the valuation discount. So you were talking about Apple earlier, which obviously has a terrific franchise. I would say that the political risk to Apple today, especially at 25 plus times, is maybe as high or higher than the drug stocks at 13 times, where you're it's a little bit of a known unknown. So look, regulatory pressure from a number of different potential administrations is real. And it's a real pressure on this market, and should create, we think, some volatility going forward, which is why at Thornburg we're keeping some powder dry. But I agree with you. At the same time, if it's affecting Pfizer at 13, why is it not, or should it not affect Apple at 25 or Microsoft at 30? Both are names that we like, but again, similar kinds of risks.
That's a really interesting point. For Apple, this afternoon, is this going to be our big market event this week? I mean, it's gone on this big run, as you mentioned here. I imagine the bar's got to be pretty high for them to deliver on all the services and new components of their business model.
The estimates for the stock and the estimates for earnings are actually, in our view, not tremendously high or not overdone. What you've seen is the growth in services on a year-over-year basis, each quarter in the mid to high teens. That's pretty strong. This is obviously a mega cap company. The other piece is there's fairly disappointing or ready to be disappointed expectations around iPhone 11 sales, mostly just in the trajectory of what has gone on. So I think really what's driving this is less the earnings. You look at what's in store for the company and what they've been able to deliver and how they've been able to beat. It looks pretty good. I think what you're looking at more is, hey, look, again, 1.6% on 10s sure makes an earnings yield of Apple 4% look kind of interesting, and certainly with a real growth story there over time. So that to me is a bigger driver.
The 5G element that can continue to drive new phone replacement, this has got to be now, I would think, part of the story, given the run we've seen. Is it as obvious that this is rolling out and being adopted fast enough for them to give guidance? Like, can Apple come out and confidently give a strong guidance based on 5G? I mean, is it that much of an obvious catalyst to the bottom line yet?
I don't know that they can. We'll see, of course. Obviously, they have pretty good visibility into their pipeline and pretty good visibility into adoption, but I don't know that that's really going to be what investors should be searching for. Obviously, it's guidance, and any guidance is interesting. More information is better. But to me, it's just, okay, are they executing on what's in front of them right now? And I feel like that they can and will. And again, to me, the two biggest pieces are just going to be better than expectations, low expectations on iPhone sales, and also, again, a continued transformation of that company into a services company.